Hello, students. So, we come to the next chapter of entrepreneurship, chapter 6. The name of the chapter is Resource Mobilization. Under this chapter, we will learn about angel investors and venture capital funds. First, let us understand about angel investors. So, an angel investor is an individual who provides financial help for small startups or entrepreneurs. The funds that angel investors provide may be a one time investment to help the business or to support and carry the company through its difficult early stages. Angels invest their own money and actively guide the company. Angels generally expect lower return than the venture capital firms. For example, let's say John has an idea for a way to power gadgets with small, flexible solar panels rather than electricity. Now he wants to execute his idea and manufacture and sell the products. But he has a shortage of capital. On the other hand, Michael is a wealthy friend of John who believes in John's idea and wants to see it succeed. Michael is comfortable with the risk that John's product may or may not work or that John could turn out to be a terrible businessman. He invests rupees 1 lakh and receives 40% profit from the John's company. John uses the money to build his business and begin the operation. So, here in this example, Michael is an angel investor for John in his startup of the business. So, angel investors can be of two types: affiliated and non affiliated angel investors. An affiliated angel is someone who has some sort of contact with you or your business. It is better to start your business with an affiliated investor because he or she is already familiar with you or your business. They can be professional person, suppliers, old customers, employees, etc. A non-affiliated angel investor has no connection with you or your business. Non affiliated angels can be professionals or successful entrepreneurs. Now, let us check some advantages and disadvantages of angel investors. Advantages: one of the biggest advantages of angel investor is that financing from angel investor is much less risky than taking loans. Unlike loans, investment capital does not have to be paid back even if the business fails. Number two is capital needed for startups can be obtained from angels. Number three, angels do not demand high monthly fees. And number four is further, angels can bring vast knowledge and experience to a new company. Now, let us check the disadvantages of angel investors. Number one is the primary disadvantage of using angel investors is the loss of complete control as an owner. That means the angel investors act as the owner and you lose the complete control. Number two is it is quite hard to find a suitable and trustworthy angel investor. And lastly, there is a possibility of malpractices in angel investor as well. So, now we will learn about the venture capital funds. Venture capital is a form of financing that is provided by professionals to small entrepreneurs at the early stage of business or just at the startup stage. This helps the new entrepreneurs in setting up new business units. The one who provides venture capital is known as venture capitalists. They provide equity or capital for business and expect 20 to 40% return within 3 to 5 months. Venture capitalists provide guidance to the business and share both risk and reward with the business partner. Let us now come to the features of venture capital funds. Number 1, investments are made in those enterprises which are new and use new technologies to provide new products. Number 2, generally investments are made in equity instruments. Number 3, the venture capital investment is highly illiquid. Number 4, venture capital funds are governed by SEBI guidelines. And lastly, the venture capitalists cannot interfere in the day-to-day management of the business. Now you might think that if both the angel investor and the venture capitalist help and guide the business in startup stage, then what is the difference between the both? So, the difference is that angel investors invest their own money, but venture capitalists invest others' money. Angel investors expect less return from the business, but the venture capitalists expect higher return, that too within few months. Angel investors can interfere in the business, but venture capitalists cannot interfere in the day-to-day activities of your business.